Ladies and gentlemen.
Welcome to the BlockCrunch podcast, the go-to podcast for investors and builders in crypto. And before we get started, just a reminder for you guys out there, the BlockCrunch podcast is intended for informational purposes only. Neither the host nor its guests are licensed financial advisors, and nothing discussed should be construed as financial advice. Views held by BlockCrunch's guests are their own, and sponsorship messages do not constitute financial advice or endorsement. With that out of the way, let's jump right in. Today's episode is brought to you by Protocol Labs, the team behind Filecoin. And with me today is Colin Efren from Protocol Labs, who leads ecosystem there, to tell us why people should choose Filecoin over alternatives. So, Colin, why should people be using Filecoin over other competitors?
Filecoin believes that Web3 will only win by offering a better product at a better price point. When it comes to storage, Filecoin offers the most scale at the cheapest price with the strong guarantees, uniquely enabled by its open market of storage providers and its crypto economic incentives. Now, smart contracts on Filecoin, which launches in Q1 of 2023, only make this more powerful. It enables users to create perpetual storage deals to store data forever at costs that are a small fraction of centralized storage providers like S3.
Hello there. Now, before we move on, I'd love to thank the hundreds of you who have subscribed to BlockCrunch VIP, because with your support, I've been able to share my real thoughts on specific projects that I don't usually share on interviews in a format that I enjoy more, which is bi-weekly written posts. We've also been able to offer exclusive AMAs, sharing my investment frameworks, interactable models, and breaking down important trends before they become big. Now, we even had Elon Musk comment on one of our threads recently. So if you haven't already, head on over to theblockcrunch.com/VIP, and you can access dozens of hours of research for what you'd spend on a coffee a day. Hey everybody, welcome back to another episode of the BlockCrunch podcast. Now, as we're recording this, crypto markets are off to a bullish start in the new year, and one of the projects that have renewed a lot of community interest lately is Frax. Now, Frax is the only semi-algorithmic stablecoin that has actually persisted its peg throughout 2022's thick and thin, even as one of the largest algo stablecoins back then, UST, was collapsing to zero. Now, with the new year on the horizon, Frax is an incredibly ambitious roadmap in DeFi to scale adoption for its partially collateralized stablecoin, Frax, its inflation-packed stablecoin, FPI, its ETH-packed stablecoin called Frax ETH, its lending and exchange products, as well as its liquid staking derivative product, Staked Frax ETH. And lately, there's been a lot of interest in liquid staking derivatives, so-called LSDs as well, such as projects like Lido or projects like Rocket Pool. So we're going to talk about how Frax compares with those two, as well as what Frax is doing in that arena at all. So to understand all of Frax's ambitious roadmap, how all of its products tie together in a unifying vision, I'm really excited to once again have Sam Kazemian, who is the founder of Frax, on the show. Now, in this episode, we'll go through a lot of very technical details about Frax's design, but more importantly, the rationale for how they design things and how they think as a DeFi protocol. I think there's a lot of interesting questions about whether a decentralized stablecoin should be relying on centralized custodians for the collateral, the trade-offs that you have to make for creating a secure and stable stablecoin versus a completely decentralized stablecoin. There's a lot of nuance to this topic, and I really appreciate Sam for taking his time to come on the show to talk to us. And finally, at the end, we're also going to touch on Frax's long-term roadmap about how Frax intends to scale adoption for its stablecoin. So definitely make sure you listen till the end of the entire episode. So without further ado, here is Sam Kazemian from Frax.
Hey, Jason, it's always a pleasure to be here.
Definitely. Now, let's kick us off with a look back to last year, because, I mean, a lot has happened last year. What were the major milestones or developments for Frax in 2022?
Holy cow, right? 2022 was definitely like a pretty crazy year. It started off like awesome in terms of the crypto markets, the stock market, everything, and then somehow continued to get worse and worse, even though when you thought like after Terra, like, okay, well, that was pretty bad. It can't get worse, right? And then, all the bankruptcies of like Celsius, like all these things, like, holy crap, okay, now it's pretty bad, right? At least we're like kind of at the bottom. It can't get any weirder or worse, right? And then FTX is just like the bad news kept coming and coming, or along with the interest rate hikes and stuff. But the year was honestly pretty good comparatively for Frax, right? Obviously, Frax was the only stablecoin other than DAI on chain that didn't break its peg at scale. Basically, what I like to think of it as like the stable coins above 1 billion supply, right? Like what the ones that at scale, what are they, right? And actually the top two decentralized stable coins other than the fiat coins is DAI first and then Frax. And we still have over 1 billion stable coin in supply, never broke our peg, continued to build. 2022 was pretty brutal, right? And not gonna lie, like all of this stuff, a lot of projects didn't make it. A lot of, real companies, exchanges, all of these things didn't make it in like a interest rate environment that just continues to go higher and higher, right? Like if you think about it, there's a lot of stuff that only exists in like a zero interest environment, right? Whether it's crypto, whether it's like Silicon Valley startups that have never, made profit or whatever, right? All of these things. And a lot of these things won't continue to exist unless rates go back to near zero, right? But that's not how we operate. So Frax has done pretty well. We continue to make revenue, continue to ship. Most importantly, I think we're one of the, best shippers of code and products and execution. When we say, we're going to do something, we do it pretty much every single time. I don't think there's any time we said we'll do something and then we haven't done it. So yeah, 2022 was brutal, but it was a pretty good year. And so now into 2023, we have a lot of good stuff because we've shipped more and more towards the end of 2022. We launched Frax Ether, right? Which a lot of people like to call it like a liquid staking derivative. And it might be like technically speaking, but it's actually important to talk about why we build all of these things rather than looking at them as like standalone products. And so we launched Frax Ether, and then we're also going to launch a few other stuff and continue to grow the products that we've already launched, like Frax Lend, Frax Swap, and these kind of things.
Yeah, definitely. And I'd love to kind of turn the focus on the new year as well, given that it's the beginning of 2023. Now, looking at some numbers currently, I think Frax, the stablecoin, has about a supply of 1 billion, I think 92% of which is collateralized. And Frax Ether has about 100 million staked. Frax Lend has about 200 million in TVL. FPI, the inflation-pegged stablecoin that you guys have, has about 80 million in circulation. So all of these are big enough to not qualify as simple experiments. These are actual bona fide products with people behind them. So in 2023, how are you splitting your focus or development efforts across these? And are there other major initiatives that will be coming on as well?
That's a good question, because the way that I like to think about it and the way that we're going to be talking about our roadmap that's going to come out by the time this podcast is put out there is Frax builds stablecoins. We build things basically as if we're building a stablecoin. So we like to think about it as if we're a issuer of a currency, which is basically like a central bank. And we'll kind of get into how we build Frax Ether that way. But everything we build is so we can issue the best stablecoins. We can stabilize stablecoins that we build, right? If you think about it, Frax is a dollar-pegged stablecoin. FPI is a CPI pegged stablecoin. Frax Ether is a stablecoin pegged to 1 Ether. And the way that we build the mechanisms and the way that we think about these things is not a standalone product that requires different kinds of, attention, and like, we don't have silos in like Frax. Frax is actually pretty lean and, fast moving organization. There's only 8 of us. All of us are engineers. We build all of the stuff that we're talking about. It's built by 8 people. So literally all of this stuff is built by 8 people. The reason it can be done that way is obviously like we work around the clock all the time, but still it's that we don't have a disjoint framework. We have a very, very clear roadmap and like a very clear vision. We build stuff that allows us to build the best stablecoins, whether they're pegged to Ether, to CPI, to the dollar, to any of these things. So that's how we think about it. So it's not like, Frax Lend is just this kind of island of like a lending market that's like supposed to compete with Aave or something like that. If it was, we would like tokenize it, right? Like we would just, there'd be like a Frax Lend token or something. There'd be like a Frax Swap token. There'd be like a Frax Ether token. There'd be there'd be a like Frax BTC token. In fact, we're looking into issuing a BTC pegged stablecoin. And so that's going to come in around Q2 is part of our roadmap. And they're not siloed. They're not siloed. They're not anything like that. The Frax DAO issues stablecoins, and there's a very unique way of thinking about the world if you're a stablecoin issuer, and that's essentially how we design everything.
So all of these products are basically shouldn't be thought of as like independent products. They should be thought of like a part of the mechanism that allows for these stablecoins to be issued.
Yeah, exactly. That's exactly correct. And so if you think about how stablecoins work, right, they need a lending market, right? They need like a credit facility. Like if you think of how DAI is generated with on-chain debt, they need a swap facility or ways to rebalance collateral, whether it's through AMM. We use Curve and we use FraxSwap. FraxSwap we use because it has TWEMs, right, which is it allows large liquidity to balance across time. Curve, obviously, it's deep stable swap liquidity, right, pegged assets. And so everything we do is built so we can issue better and better stable coins without having to rely on, for example, like our stablecoin being listed on Compound or on Aave and stuff, and being able to build these kinds of things you need for issuing currency internally.
And this is actually a question I wanted to ask later once we get at the community question portion, but I thought it's a good time to bring it up now. So given that there are lending markets for Frax right now, is there a risk that, you have one large actor that just borrows a lot of Frax and, push the Frax price down to 90? And just to give some context for listeners, basically right now, if you have a Frax stablecoin, you can redeem with Frax. I think you get like 90 cents of USDC, but the protocol mints 10 cents worth of FXS tokens. So I think one of our listeners asked, is this open to the similar risk that face some other kind of algorithmic stablecoins, especially with lending available now?
It's a good time to talk about the Frax part of the roadmap. One thing we're changing about the Frax stablecoin is this year. So right now the collateral ratio is 93, give or take. So 90, 93 is fairly low. So the rest is the 7-8% is FXS and volatile assets and stuff. We're actually changing Frax entirely 100% CR to exogenous collateral, fairly safe collateral. In fact, you might have heard that one of the things we're working towards doing is getting a like Fed master account or like an actual way to get either direct deposits at the Federal Reserve System or Treasury T-bills in an isolated account, similar to kind of like Paxos, a little bit like Circle, slight differences, but we have our own basically isolated secret sauce, so to speak. And so Frax will not be at any CR different than 100% above or below. So we're actually increasing the CR to 100%. It still makes it the most capital efficient stablecoin. If you think about it, DAI is 130% CR, right? So to mint every single DAI, on average, the reported CR is 130, right? So you need about $1.30 of collateral, like Ethereum or other kinds of things they accept as loans, right? And so if Frax is 100% CR, it is actually the most capital efficient decentralized stablecoin because our AMOs and stuff will keep the CR always balanced at 100, not below, not over. So it is still the most capital efficient, but it'll be 100% CR.
God, actually, on that point, right, if you guys are backing Frax with treasuries or deposits as well, does that introduce a vector of centralization, given, there must be someone controlling the bank account, or maybe it's you guys running the bank account?
Yeah, so two things. This actually gets into theory as well as practice, right? Like the bank account and these kind of things. So my take, and I think this is the adult take, and I think it's easy for people on Twitter or like other things that everyone always has opinions. But like I said, we build the best types of stable coins. And so for the dollar peg stable coins, the fact of the matter is, and again, I would love to debate anyone. I would love to talk to anyone. I would love to, in good, respect, have a serious debate. But any way that I look at it, it's impossible to peg a dollar stablecoin at scale if your goal is to get to hundreds of billions, if not trillions of market cap in all seriousness in the next 5 to 10 years without having at least one single real world asset. And that's their deposits at the Fed, debt of the US government, or just wrapping another fiat coin that has those things. And so we don't want to wrap another fiat coin. We don't want to be something where the closest thing we can get to off-chain is essentially by having to entirely rely. We might still have a large amount of fiat coins in on-chain swap facilities like Curve and deep liquidity in these kinds of places, but we don't want that as our only option. That is not how Frax can end up becoming in the next 5 to 10 years in the hundreds of trillions, if not hundreds of billions, if not trillions, right? And so really, that's the only way you can actually be the top first, second, third rank dollar peg stablecoin. I'm willing to talk to anyone to and debate them if they have any views on this. But as one of the, like I said, we do research on building the best types of stablecoins, no matter how we do them. In fact, when we talk about Frax Ether, it'll be important because there's analogs to this, right? Which is you always need whatever you're going to peg to if you're trying to be the largest issuer of currency, either in like the digital realm, right, which is stable coins, or in the real world or whatever. You need to become the closest thing to the risk-free assets. Okay, right now that risk-free asset is like USDC on chain. Okay, that risk-free asset is USDC. People like to talk on Twitter. How will they? What if they, blacklist, blah blah blah. And it is true. It's not wrong to worry about it, and we should worry about it. But no one ever comes up with anything. They say, oh, like look at LUSD, which has like a fraction of a fraction of a fraction of the market cap of like DAI and Frax and things like that. Or look at this random decentralized like cute peg of something. If there's no actual data, there's no actual thing, unless there's some kind of super secret stability mechanism that has never been invented, and some kind of new crypto way of doing things, which we're exploring certain things, but like the BAMM stuff that we're talking about, and maybe we'll have time to talk about, that lowers the exposure, but it's not possible. No one has actually came up with like a real way to defeat the famous stablecoin trilemma, right? I think we kind of talked about it on the last time I was on BlockCrunch, or maybe I also talked about it a few other times, that there's just no way. And so we're not going to, at least not known yet. I'm not saying there's like mathematically impossible, but no one has come up with a good solution. Everyone likes to complain about, fiat coin exposure, and they're right, but they still continue to use USDC because you can't use something like LUSD at scale, right? It's wobbly to a couple cents. It also uses Chainlink Oracle, so it's like, oh, it's really like decentralized, sure, but like it only uses ETH, but it still uses Chainlink Oracle. So like if we didn't use USDC, people would be saying stuff about the Chainlink Oracle, right? Or like if LUSD actually could be larger in market cap rather than 100 million or something, it would be even more unstable, right? It's a couple cents off and on peg. It's wobbly to plus minus like couple cents, right? There's other stuff too, like the thing is, there's just no way to get to the major leagues in terms of size without having at least one real world asset. And so what I actually like to talk about is the opposite direction. If real world assets are like a big thing, does it make sense to have a stable coin that has many real world assets, like the way that MakerDAO is going, or only have one real world asset? And so I think that's actually another interesting conversation. Frax is taking the other approach. We're not actually, originally we were thinking of exploring a lot of these different real world assets, like Tesla loans, different lending to different banks and all this stuff. Totally not doing that anymore. This is not the avenue that we're going towards. We just want one real world asset. That one real world asset is deposits on the Fed's ledger. That's the only real world asset. Everything else, we're going to be entirely on chain, entirely, our AMOs, that algorithmic market operation contracts that manage liquidity on things like Curve, Uniswap, etc. They also changed the lending liquidity on Frax Lend, right? So they mint Frax to be borrowed in certain pairs that pass governance votes, very similar to MakerDAO's CDP system, increasing and decreasing the lending ceiling. What's more important, I think, is actually talking about the philosophy and the idea of like, why are you taking kind of the one real world asset view rather than the multi real world asset? And so for that, actually, as we thought more and more about it, if you think about making loans to private entities, which is what the real thing is of real world asset, it means lend to a bunch of random stuff, right? Like, and I don't mean random as in bad, like I mean private banks, private businesses. Sure, there's a lot of private businesses that are very safe, right? Like Apple, Microsoft. There's really not a lot of chance that Apple is going to default on its debt or something, right? But the thing is, if you think about what entity's job there is to lend to these things, it's the private sector. They're commercial banks. Notice how central banks don't lend directly to Apple, to Tesla, to these kind of things, right? They create the money, right? And then they give it to commercial banks. They technically, they lend it with reverse repo agreements, or they actually just, all of the stuff that's out of scope to talk about here, right? And then the banks actually go and lend it to Tesla, Apple, and all of these like mortgages and these kinds of things. We don't want to be the commercial bank. We don't want Frax to be in place of the commercial bank. We want to actually be the closest thing to the central bank of DeFi, of the digital economy, right? And so the thing is, when everything bad happens, like right when there's a crisis, when there's like a liquidity crunch, right? Everyone flees to the risk-free asset, or the closest thing to the risk-free asset. This is just a fact, right? This is an economic fact. On chain, what is that? That's USDC, right? Like that, we call it spade a spade. It's USDC, right? It's not Frax yet. It's not DAI. It's not like Tether. It's USDC currently, right? The general consensus is that it's USDC, and they've done a great job. And recently they have BlackRock managing all of their treasury assets in a money market fund that is only accessible to them, that buys reverse repo agreements from the New York Fed's trading desk, right? It's a very good operation. That is the risk-free thing, other than, the issue with the blacklist and stuff, which we should talk about. It's not at all denying any of that, right? But you're always going to end up wrapping the closest thing to the risk-free asset. There is no, at scale, there's no exception. There's no exception. If you end up doing some of these riskier loans that can default, like that can default, but likely probably won't, but you never know. Tesla to these like other banks and stuff like the Maker's doing, which is awesome. They're more profitable, right? Risk adjusted. That's why you get a higher interest rate than the risk-free rate at the Fed on the interest on reserve balances or reverse repos, right? But everyone will flee to the closest thing to the risk-free asset in the worst amount of, or you as the riskier stablecoin issuer like DAI and currently like Frax, you will end up having to wrap the closest thing to the risk-free asset. That's just a fact, And so we don't try to deny it. We don't try to, market our way out of it. We try to solve it in a very unique thing to that we think that no one else is doing. And so we have some stuff we're working on. Like I said, we take a one real world asset approach. The one real world asset, again, is deposits at the Fed or like reverse repo. Fed is the only counterparty or close to it. Circle's pretty close, actually. And we're not going to loan to like, renewable energy or whatever, or some other banks and stuff. It's too difficult to assess that kind of risk. That's what a commercial bank does, right? And so we're not interested in being a, commercial bank stable.
That's what Maker is trying to do, I suppose.
I think so. And let me be frank. It's profitable, right? You take higher risk and you get higher yield. So like, there's nothing wrong with it. And Maker's doing a good job at doing that thing. We're not going to compete with them. We're not gonna try to lend to real world assets that, so like, then they can be like, well, Maker's giving us DAI at like 5%. Can you give it to us at 4%? Frax and stuff. We're not going to get into that at all. That's not something we're interested in.
Does that mean the end state for Frax will, look more like, a Circle or Paxos where you have, licensed agreements with all these banks and custodians, or is that kind of, I guess from what you're saying, it sounds like you will be the decentralized central bank that interacts with entities like that versus becoming an entity like that?
One entity. The goal is a very, very simple way for the Frax DAO to, again, we're trying to keep it very, very clean in terms of the vision here, which is there will be one entity, the Frax DAO. There will only be one thing off of the blockchain for the FXS token holders and the governance votes and stuff to actually manage. It's one real world asset relationship, not 50 counterparties. Not, in fact, that's one of the main issues, right? One of the main issues is that the current way that the traditional financial system works is that you almost literally legally have to go through like 10 middlemen, right? And like legally, you can't have an account at the Fed. Trust me, we understand how impossible it might sound to get the Fed master account or some kind of repo facility or something like that. But you need to go through. You need to either be like a SEC registered money market fund. You need to be either like a systemically important bank to be like a counterparty there, and then you need to either, if you don't do that, right, then if your first counterparty is one of those things, right, then you have like a broker that then if you have T-bills, like then they hold your T-bills too, and then you're like, well, let's have a trust, and so it's like creditor protected in case like one of these things goes bankrupt or something, so that you hold the assets for your your users, which are the stablecoin. But now there's a third layer. Fine, it protects it from two at the bottom. Now you interact with trustees, like you're saying. Okay, so the token holders are talking to trustees, I guess, or whatever. I don't know, right? And so then there's like the layer above that, and then we want to just have the whole stack simple. That's going to be the goal for this year. That's on the roadmap for 2023.
And speaking of roadmap, I think we can go on and on with the stablecoin part of things because there's a lot of big topics that we can discuss. And I do think it's the most important vertical in crypto. But I think we do have to move on to liquid staking because that's something that a lot of people are talking about today, especially with the recent price moves and all of these liquid staking protocols. So one of the things that people are really excited about is Frax ETH. So just to give some context to listeners, what is Frax ETH and how does it work?
Yeah, so Frax ETH is an Ethereum pegged stablecoin. So one Frax ETH, FRX ETH, is pegged to the price of 1 ETH. It does not accrue rewards. It does not accrue any interest. It's just an Ethereum pegged stablecoin, and it's always backed by at least 1 ETH. So there's no like weird mechanism, or it's always just backed by at least 1 ETH. Now, why did we do this and why did we build it like this? There's a second token called staked Frax Ether, which when you mint your Frax Ether stablecoins, by depositing 1 ETH, you get 1 Frax Ether stablecoin out. You can go and deposit your ETH stablecoin in the staked Frax Ether vault, and you get out S Frax ETH tokens, right? And those are the things that they're interest bearing. Those get all of the rewards of the proof of stake validators that currently run by the Frax team. We have a roadmap to decentralize those, kind of similar to Rocket Pool, but a little bit different mechanism. It's going to be out a little bit after Shanghai, but the economic innovation here is building this out like a stablecoin. So the Frax ETH token does not accrue any interest. When you mint it, then you can decide what to do with it. As more and more places end up having integration with Frax ETH, that maybe they'll replace ETH with it, for example, or maybe there'll just be like curve pools and things like that. We obviously launch with a pretty big curve pool that we support, just like how Frax is everywhere on Curve and on stable swaps and these things. So then you can decide, do you stake it in Curve for like about a 10% APR, or do you stake it in the POS vault? It's almost the same risk-free, right? Like the POS vault, it's still just the POS rewards, right? Curve, minimal smart contract risk, as blue chip as it can possibly be, right? Frax ETH paired with ETH, no IL, right? Like basically it's pegged to the same thing. No risk there. It's almost the same as the risk-free rate. What happens is the interest rates get arb, right? You have to decide where to deposit your ETH stablecoin. And what happens is the actual vault acts as essentially the risk-free rate of the Fed, right? Like if we're the issuers of this Frax ETH stablecoin, so it's similar to dollars, right? The risk-free rate that we offer is in the POS vault. Whatever is the proof of stake rewards, they all get distributed to the POS vault, minus a small fee, right, for the protocol. Then when you have your Frax ETH stablecoin, you can decide, do I want the risk-free rate, right, which is the POS reward yield, or do I want somewhere like Curve? There's places in Balancer that are starting to integrate it. There's other AMMs, there's other projects that are starting to integrate it. In fact, there's Polygon projects and stuff that are starting to integrate it. So there's going to be a Frax ETH way to bring it up to Polygon soon, right, using the ferry system that we've deployed as well in 2022. And the idea here is the stable coin is the thing that's pegged to 1 Ether, right? And that is basically the actual money, the unit, the thing we are trying to get people to replace ETH with, right? That we're trying to get AMMs to use Frax Ether, right? And we're trying to basically change the unit of accounting everywhere to Frax Ether, and we have extra incentives and these kinds of things. In fact, there's going to be a Frax Ether base pool system, which anyone that actually pairs with Frax Ether, right, the same kind of thing we have for Frax BP, they get a part of the incentives. It's almost like a proportional interest rate, right? That's proportional to how much you're using the Frax ETH stablecoin. Same idea. We have the Frax BP, which is the dollar pegged stablecoin system like that, right? And this is pretty powerful. If you think about it, what is the measure of use of a currency by an issuer, right? The actual measure of use is how much spot demand do people actually have for your currency. What that means is how much do they have in their wallet holding it as a spot, right? They're not expecting you to give some amount of interest rate for you to hold that thing, right? And so just like, for example, USDC, they don't incentivize anything, right? They literally don't incentivize anything. People hold it, they use it for payments, and they use it for paying salaries of treasury, they use it for investments, all these things. You have to be able to create a project where eventually that happens with your issued liability, right? That's the ultimate final way. Any of this stuff, whether it's ETH, whether it's Frax ETH, whether it's all of these things, that's going to be the LSD that wins. I like to call it an ETH peg stable. Now you can kind of see why we separated it, right? We need at least one token where eventually holding it will give you 0% interest. So people can actually hold it spot. So all of the LSDs that is essentially pay an interest rate because they're essentially a yield product, right? They will never be able to benefit from spot demand because anyone that holds their actual like ETH, REITH, and all these things, and I love the project. So we're obviously going to have a lot of pools with them. The more yield, the better for all of our growth, right? So you know better than anyone, I'm a very positive sum person in terms of like the best thing is everyone growing together and wealth being created rather than trying to lower people's market share, right? The main thing that we always think about is how can we grow and how can everyone else grow rather than how can we increase the distance between us by pushing people down, right? We want to push everyone up. But the issue is, and I think it's an easy fix. I just have to think about it like a stablecoin issuer would, right? The issue is they can't get any organic demand for every single ETH someone holds, right? Lido is forced to pay them the exact same rebasing rewards, right? That no organic demand for ETH benefits Lido, right? If you think about it, if you put this thought experiment in your mind, but with Frax ETH, That's not true. There's two tokens, the staked Frax ETH Volt token, which is the one that's accruing interest at the, the risk-free rate, right, from the POS rewards that get sent there. And then there's this other one that has 0% interest. If you just hold Frax ETH, right, you're using it to send ETH to people, or you're using it to market make in an AMM pair or something like that, you earn 0%. Although now, obviously, for a long time, for a couple years, I assume, you'll earn something, right? Because we have to jumpstart the whole ecosystem for at least 2, 3, maybe 3.5. Some, who knows? We'll take a look at 4 years. Holding the Frax ETH one will also obviously have a bunch of incentives, but eventually, if it's going to be used as money, it needs to actually be used with getting paid 0% interest. Otherwise, there's no demand, right? Like, if people can think about this much easier with dollar peg stable coins, right? You'll see that only USDC and Tether and DAI has a very good spot demand. Actually, Frax is starting to finally get it too, but with all the blood, sweat, and tears of work that we've done. But like, no one holds any stable coins spot other than the extremely established ones. They're either trying to get some yield on it or dumping it after getting a loan, right? They're selling it immediately into the market, which might lower the peg, right? But USDC, DAI, a little bit Frax is slowly getting up there, but USDC and DAI on chain, they have a lot of organic spot demand, which is just another way of saying people hold it idle and they use it as payments, and they don't expect to get paid an interest rate. They're getting paid 0% on it by the issuer. That is the only way to measure organic demand. So that's actually what led us to the design of Frax ETH, and why we think about it like an ETH stablecoin, why we built it like that. And lo and behold, we are the fastest growing, LSD, if you want to call it that, in that category. I mean, we're just, like, obviously it'll be harder and harder to grow as we get to like Lido size or close to it or something like that, right? It's going to take months to get into the hundreds of thousands of staked ETH. We're right about 60 or 70,000 ETH staked right now as we talk. But we're already like the fourth or something largest, LSD. And the reason is we have a very elegant and the most capital efficient model. A lot of people get confused. When we first launched Frax ETH, right? People were really confused, and it's okay because they don't think like currency issuers, which is fine. But they were thinking like, what's the point? Like, okay, all I'm gonna have is the Frax ETH, the staked Frax Ether token from the vault. Why does Frax ETH need to exist? Why are they making it so complicated? Why is this so stupid? In fact, it's not more complicated. It's actually more capital efficient. It's better for growth, and it allows us to measure the organic demand of Frax ETH as a currency rather than as a proof of stake farming project, right? Like we farm the proof of stake yield and we give it to you, and that's what we do. We don't do that. That's not the reason we built this, because we thought it was cool to be just another LSD. Like, a lot of people are going to launch LSD projects, right? Getting closer and closer to withdrawals, because it's going to be the trendy thing to do, right? And like there's going to be hype for their tokens and stuff, and that's fine. But we didn't launch it for an LSD project. We launched it to launch a Frax Ether pegged stablecoin. That's the reason we launched. Obviously, we have the best validators. We're working on validator technology. That's what they're backed by. That's what pays for the risk-free rate, right? Our validators right now are the best rated on Rated Network and other validator scoring sites, and we're constantly working on it, of course. So like we do have a liquid staking kind of service, but like I said at the beginning, if you want to understand why we're building all of these things and why it doesn't require like siloed attention, it's not like there's like all these islands of projects like Frax Lend or Frax Ether and Frax. They're all the same thing. They're all built like currencies. And so if you go back to what we were just saying about like the Frax dollar peg stablecoin and the one real world asset model, right? Deposits at the Fed. If you think about it, the structure of that exactly the same, right? The yield on the Fed deposit is like the proof of stake yield, like kind of, right? It's like Like if you
product
stake the
difference.
dollars at the Fed, right? You get the POS rate of the dollar, right? And then that income comes to the Frax balance sheet, right? That goes to the Frax DAO, right? And then you can either, figure out what to do with the income. You could create like a Volt or the Frax BP system or whatever, same exact structure. And then the dollar-backed stablecoin that has a 0% rate, right? If you hold that, zero interest. It's same structure. Everything is built as if we issue money. That's the overarching concept of everything we're doing.
And there's a lot for our listeners to digest, so I want to make sure they understand this part because it's very important. So just to synthesize here, the major difference that Frax ETH has with other so-called liquid staking derivatives or LSDs like Lido and Rocket Pool is that you guys also issue a synthetic ETH, which is Frax ETH. Whereas for Lido, for Rocket Pool, if I use them, I just take my actual ETH, I deposit, I get my staked ETH in return, or my Rocket ETH. Whereas for Frax, I can actually mint a synthetic Frax ETH. And then if I want to, I can also turn it into staked Frax ETH and earn that yield. And the difference is you guys basically capture the market demand for spot ETH, not just staked ETH as well. Is that kind of a correct synthesis of why you guys did this?
Perfectly said, Jason. I mean, you're a central banker, right? Like we try to capture the monetary demand of like the monetary premium that we hopefully create as Frax either permeates the ecosystem. You can't capture monetary premium of something if you're paying your risk-free rate to every single person that is possibly touching your token, right? And in fact, it's not like a irreversible mistake. In fact, like it's very simple to fix. You just create an unrebasing wrapper or something. Lido just has to do that, and then they'll have a non-rebasing one. But they're gonna have to, every part of their like economics, they're gonna have to think about it like a currency. Maybe they don't want to do it. They're probably not interested. I mean, they have the largest market cap, so maybe we need to actually stop thinking like this and do it like that. I don't know, but this has worked very well for us. It's worked well for central banks, right? In terms of getting currency widely adopted. The structural mechanics of the economics is the same, right? People say crypto is like speed running economics, right? They're just discovering the same exact economic rules, but like really, really fast. And I think there's a certain truth to that, right? If you build the right kind of structural economics and don't get things disastrously wrong, like starting with 0% CR like Luna, you can do a lot of good things, right? And so I think everything we're building is from the first principles of how does it work as a currency. If we're right, I mean, like I said, if we're wrong, actually the right way to do it is Lido, like rebasing, having validator rewards update to Steve tokens every day or whatever. But if we're right, we should be able to be continually the fastest growing, LSD and benefit from the monetary premium that Frax Ether gets.
So just to clarify, for Frax ETH, not the stake Frax ETH, for Frax ETH, it's one-to-one backed by ETH deposit in a vault, right? It doesn't have any kind of fractional reserve. Like you guys don't take part of the ETH and stake it or anything like that.
No, we don't. It's 100% CR. Some of it has a curve AMO, which is basically just backed by ETH and the LP. So it's basically the same thing. So right now there's no withdrawals. So one of the things we did is we designed a curve AMO, right? Which basically takes some of the ETH that people deposit to mint Frax ETH and then just LPs it in the curve. And so that's 100% CR as well. Because in order to ever actually get one Frax ETH out of that curve, we have to put in one ETH, or you sell one Frax ETH and then you get out one of the ETH that's LP'd in there. So it stays the same. So it's 100% CR. And in fact, it's actually technically higher CR than something like Lido and stuff, because all of their ETH is staked in the validators, but only around 90% of our ETH is staked in our validators. The other ETH is liquid, right? It's the thing that's churning in the AMO for the curve pool, right? Which is why actually, if you look at the historic performance of Frax ETH, albeit it's much smaller than Steth, of course, but it is ruler flat. It is 0.9999. Like the peg is exactly correct. It's never deviated. even as it's grown, right? It's grown like parabolically. The peg is not deviated. People haven't like dumped it and it's like depegged or anything. It works quite well. And obviously, when withdrawals open, there's nothing needs to be said, right? Everyone can withdraw that, and there's basically infinite liquidity. You just undo all the validators, and people get 1-to-1 ETH for Frax ETH. So in fact, I would actually say not only is it always 100% backed by 1 ETH, at least it's actually more liquid than all the other liquid staking derivatives, because part of it is in a liquidity AMO until withdrawals open, right? And so some of the ETH is actually getting curve fees rather than proof of stake.
And speaking of validators as well, I think one community question was, how are you guys handling validator distribution right now? Because as we understand it, it's a little bit more centralized than Lido and Rocket Pool at this stage, right? So you guys are running the validators. Is there a plan to kind of decentralize that, and what does that roadmap look like?
Yeah, of course. So right now, the Frax core team runs the validators. They're on commodity hardware, geo-distributed across continents. We have professional stack of managing them, load balanced, perfectly isolated. It's not like some kind of, I think people know by now from the amount of work we do and ship, and like we've never had any kind of security issues with smart contracts or anything. We have the highest standards in terms of security, but we run them. Yes, the Frax core team manages the validators. We do not anticipate that being the end goal, to just like run it kind of like you would see Coinbase or Binance running it as like a just a person in the organization that or team that manages all of these things, right? We anticipate basically allowing anyone to come and run a validator. The way we do it will be slightly different than rocket pools. I really like rocket pools, actually, the mini pools, and being able to spin up your own validators for as capital efficient way of possible. So right now you put 16 ETH. I think they're thinking of lowering it to, I believe, 4 ETH, something last time I checked, which is good, because if you get slashed, you get ejected, right? So you don't need to actually put up 16 or even 32 to get some ETH delegated to you to run a validator, because if you get slashed, then you get removed from the queue. So you only need to put up as much collateral as it takes for you to have a really bad slashing, right? We're going to do it slightly differently, and we'll announce how we're going to do it, but people will be able to essentially borrow, if you will, through a modified Frax lending pair, the ability to borrow the right to run a validator. So it's actually going to be very interesting. It's going to use our infrastructure that we've already built to continually just aid improving the stablecoins that we have. So Frax ETH being one of them. Now, one thing I do want to mention, again, Lido is the top dog. And so like they're obviously, maybe they're the ones doing it right. But for example, I don't think any LSD currently is as decentralized as people like to talk on Twitter. For example, Lido has a whitelist, right? And in order for you to be a Lido partner, you have to identify yourself, you have to KYC yourself. They always control the entry point in you being able to actually become a validator, right? Like they can say next year, oh, like, our community rules of being, super awesome include not, doing X, Y, or Z, right? Now now if Lido had 100% of the stake, right now that's literally becomes essentially a way to exclude people from running Lido validators if they have like a vast majority of it. Personally, I don't think this is a problem, because no one is going to get anywhere between like 51 to 66%, right? You need 2/3 to completely destroy everything. And I know Lido has close to a third. And obviously the third, again, is distributed for their partners, the ones that they've, whitelisted, KYC'd, and things like that. And obviously it's better, clearly, that different people have, different partners have different amounts of stake. But we're going to try to shoot for a more permissionless end state, right? I like Rocket Pool. I like the fact that it's more permissionless. It's not a whitelist. Obviously, Lido's is the most, again, capital efficient, right? And so like they started first, and they're also in the lead. They're growing faster than Rocket Pool. So it's a lot of, you have to actually weigh a lot of what values you stand for, like what you're actually interested in, right? Because if every single person that wants to run a node on Rocket Pool has to give 4 ETH, right, or however much, right now it's still 16, I believe. That's more expensive than Lido that just says, hey, we're just getting a bunch of ETH deposited and minting ETH. Do you want to like KYC your organization and run a data center or something and run our validators? They don't have to put up 16 ETH per validator, right? So it's much more capital efficient, right? And so you have to weigh all of these different things, and it becomes it's really easy for people on Twitter to just have like crazy opinions, like how crypto Twitter is, oh, this is so decentralized, this is so centralized, this is such rubbish and stuff. But they're hard decisions, because on one hand, some of the decisions help you compete better, right? Make you more capital efficient, make you capture market share faster. Others are about, continuing to have the crypto ethos, and like our long term is to continually make products that match as close to possible while keeping the $1 trillion vision of stablecoins, and seeing that as an opportunity in the 5 to 10 year period, with that reality of actually needing to make some kind of compromises, right?
And as a user myself, I always find myself thinking of the risks of different products when I use them in DeFi. And one thing that I thought was quite interesting is that all of the different LSD protocols seem to have different approaches to handling slashing. So for Lido, for instance, I think if you deposit your ETH and your validator does something weird and it gets slashed, I think you lose all of your ETH. And I believe the loss is socialized across all the STETH holders. But I think Rocket Pool might do something different. How does Frax handle slashing risk? So if I, as a depositor, I put some ETH, I put some Frax ETH into stake Frax ETH, the validator gets slashed, what happens to me?
Yeah, so there's two parts to that answer. One, first of all, yeah, that is how Lido works. That's also why they need to KYC, to make sure if someone messes up, they can be like, hey, like, you screwed up, we got slashed majorly, and now we have to socialize it, right? Rocket Pool forces you to put up collateral, right? So if you mess up, there's more than enough ETH for them to take from you and say, you messed up. Here's the validator, here's the proof on chain. Currently, Frax is two things. One is, so we take a 10%, the protocol takes a 10% cut, similar to Lido. 2% of that always gets put to the side to like an insurance fund for like slashing or performance, and it's already being accrued, right? And separately, it's not being used to risk or like lose or something. It gets put aside for slashing insurance fund. And the second part is, yeah, so after anyone can run a validator, there's going to have to be some kind of system where they get either liquidated, right? If it's like a loan, remember I called it kind of a modified Frax lend pair, where you come and you say, I want to run a validator from the balance sheet of all of the Frax Ether collateral, right? That people are depositing ETH 1-to-1, right? And you have to put up some amount of collateral. And if you get slashed, your LTV changes, right? Every validator will have some kind of LTV, and they will be paying out some kind of rate to lenders. So the largest lender is probably going to be Frax Ether, with all of this stake that the ETH they have to be able to lend, right? Other people can come deposit Ether in that. And so if you're a validator, right, you have to always make sure that your LTV, so to speak, right, if you get slashed, you lose some ETH, your LTV is good. Otherwise, you get liquidated, which means the ETH in there gets taken, right? The thing people are lending and risking for the yield you're paying, and some ETH that you deposit, and then you get ejected from the queue. Obviously, you lost some ETH as well, which is what gets replenished from the ETH that the protocol takes from you. So in order to run a permissionless validator, you do have to put, obviously, collateral, just like Rocket Pool, right? And for us, we're thinking of it more, again, like a over-collateralized loan. In fact, it's kind of like a modified Frax lend pair, where every validator kind of has their own unique, isolated lending term sheet, so to speak. So like if you want to run a validator, you can come and be like, okay, my validator address is like, 0x blah, blah, blah. I'm paying a yield of 12% or whatever, and who wants to lend to me? Well, people are going to have to make the risk, right? And you're going to have to put some collateral yourself, right? Again, similar to Rocket Pool. And then people deposit their ETH to earn some of your POS yield. You can even jump started with other kinds of token incentives if you want. So it's actually a very, very cool way for other DAOs to run parts of their validators. So it's actually going to be very interesting. It's not finalized yet. So again, I usually don't like to say exactly how things work, because then if we change some of it, people will be kind of disappointed. They'll be like, you said on this, podcast, it was like exactly like this. We're still designing it. But again, the goal is to have the best way for DAOs, projects, and individuals in their, homes and things globally to just be able to run validators. And the way you do that is essentially borrowing the right to have it from lenders and then paying them an interest rate. Well, where does the interest rate come from? It comes from you, from your validator, earning rewards. Or if you're, a project, or, you want to pay extra token rewards and other stuff other than the ETH you earn, you can do that too. You could pay the interest to the Frax lend pair in the tokens.
Got it. That's very clear. Thank you for that. And I guess one last question on the Frax ETH part before I move on to the final part is, so currently staked Frax ETH is offering the highest yield out of all these protocols. You guys are offering, I think, 10% or so with this kind of convex mechanism. Can you explain a little bit about how that works? And, is there a plan to kind of diversify the reliance on kind of convex subsidies?
Yeah, two things. One is the yield is obviously based on the principle that we talked about, is when you mint Frax Ether, right? You kind of have to decide, do you want to LP it in Curve, or do you want the risk-free, POS yield rate, right? Which is like the kind of the central bank's interest rate, right? And if you think about it, what would have happened if we did not have this system? Everything was like a rebasing token like Steve. Every LP in Curve would also get the risk-free rate, and basically no one would even stake in this POS vault, because you first stake it and then you have to go put it there. Otherwise, you're missing out, right? In fact, this actually makes liquidity cheaper, right? Because you have to decide whether you want to get paid for providing liquidity or you want to hold the vault token. And so we're actually able to provide this yield more sustainably. Obviously, as we grow more and more, we have to actually get Frax Ether, the stablecoin, to be used in different places, to be used instead of ETH, to be used on other chains and things like that. Otherwise, the yield will drop, right? I mean, that's the thing. They'll drop to similar performance to Steve, right? Because like it might still be like marginally better for like a long time, just because obviously the curve and convex flywheels are good, and we put a lot of time into that. But there's no way without getting monetary premium you can keep these kinds of APRs, other than the fact that you need people basically using it, right? And so like one of the main things is we don't try to overpromise. We don't try to like do anything unsustainable. In fact, like we were talking about at the beginning of the podcast, 2022 came and went. We're still here, stronger than ever, right? And continue to ship. And our incentives are sustainable. They're healthy. We budget them based on the revenue that the DAO makes and the amount of CVX tokens we have, other tokens we have, the protocol on liquidity and everything like that. So we don't overpromise. 10% might sound kind of like the new coming of Anchor for like LSDs or something, but it's not. It sounds great, and so people are saying I'm staking it in. It's fully backed by ETH, and I'm here telling you it's obviously not going to be like that at scale, right? At like billions of dollars of ETH, it won't be 10%. It'll be closer to Lido's, but that's not bad. It's just the same thing as Steve. We're not trying to overpromise and being like, we're static, we're going to keep it at 10% and we're going to, this and that, and we're going to mint tokens. And no, I mean, the way that we have this thing growing is that we're able to capture monetary premium. We're able to split the interest rate for providing LPs or just POS rewards. It makes it double as capital efficient. We're small compared to Lido, even though we're the number 4th or something LSD. As it becomes the size of something like Lido, it'll probably approach closer to light. But so what, right? Then it's basically like steep.
Definitely. And I'd love to go on and on about liquid staking, because there's a few more questions that I think our community has as well. But I think we have to move on to the last part for the purpose of time. And this is more of a general question for you, which is what are the major initiatives to increase adoption for Frax, especially given what happened last year with UST and a lot of the loss of trust in crypto, people kind of just running back to fiat coins. How do we introduce that trust back, and how do we bring people back?
Well, yeah, I mean, that's a good thing to bring up because, like I said, at the end of the day, the closest thing to risk-free in terms of the dollar peg stablecoin is well-run fiat coins, right? Well-run, transparent, audited things that are closest to Federal Reserve deposits. So I think when Frax is 100% CR, it is as close to risk-free as we can possibly get. Again, it's not obviously risk-free, but it's basically becomes the same risk profile as USDC, which is the de facto closest thing to risk-free crypto has. I think that will speak for itself. Now, the other stuff like Frax Ether and things, you can think of those as decentralized stablecoins that will never touch a fiat bank account or anything, right? But like I said, a lot of stuff we build is with the crypto ethos, but with the reality of the structure of economics at scale, right? And so Frax Ether, totally sound. It's entirely contained, right? It's entirely backed by ETH, which is the thing it's pegged to. There should never be any scenario in any case where Frax Ether requires like real world assets, right? Or anything, or even like for whatever reason, having KYC features that are like gated or things like that, right? And the Frax dollar peg stablecoin, I think people will feel better and better every month using them and using that as like things in Frax DP and everything, and just holding it idle. The safer it gets, it's already extremely safe. It's never broken its peg. It's been, the most reliable on-chain stablecoin like DAI. But I think in order for it to be in the conversation with things like USDC, like Tether, like BUSD, it's going to have to be 100% CR. It's going to have one real world asset. And again, that real world asset is the closest thing to deposits on the Fed's ledger. And I think that'll speak for itself. If we can execute on that, I think Frax will be essentially like USDC. But without the blacklist, right? So it still will be a structural non-custodial stablecoin. And so we're going to describe how that's going to be able to be possible with the way that the real world collateral for like the Fed deposits and things like that work.
Yeah, definitely. And I think that's an amazing note to close this on. So we'll link the 2023 roadmap to our listeners below. And for people who want to keep up to date with you, with Frax, as always, what are the best channels for them to do this?
Yeah, of course. I'm always on Telegram, the Frax Telegram at Frax Finance. The Twitter is the same at Frax Finance. And for me, Telegram and Twitter is basically where I am around the clock. I'm working and have the Telegram tab and Twitter tab open on the side at Sam Kazemian.
Awesome. Well, thank you so much for coming on, Sam. This has been great.
Awesome. Thanks for having me.
All right, that's it for this week's episode of the Blockcrunch podcast. So thank you so much for tuning in. If you enjoyed this episode, please make sure to subscribe on your favorite apps. And in case you didn't know, this interview is also available as a video on YouTube. And if you tagged the Blockcrunch on Twitter this week and tell us what you liked about this episode, I'll be sure to respond to you as well. Now, if you'd like to go even deeper, we have a VIP tier where every week or so, we write an in-depth research brief or investment memo on a project. And we'll have exclusive AMAs with myself where I answer all your questions as well. Now, we already have analysts from some of the top funds and companies in crypto as subscribers. So if you're serious about getting an edge in crypto, head on over to theblockcrunch.com/VIP to learn more. And once again, thanks for supporting the show, and I'll see you next week.